Alphabet Inc., aka Google, is a classic, iconic, very fast-growing growth stock. As you can see here, looking at the sales, at price per sales per share, Google has grown sales at almost 29% a year. And you can see that the stock price has really tracked where the sales go. And as the sales grew, the stock price grew. Now all of a sudden we see the price to sales being significantly lower than historical norms. The blended price to sales is currently 5.66. But if we look to the future, expectations are that sales are going to slow down to 15%, or roughly half of what they've historically done. That still makes Google, from a perspective of price to sales, look extremely cheap. However, there is one thing I think that you need to know about price to sales, or you need to take into consideration. If we look at normal prices to sales over history and use the drop-down provided by the fast graph tool here, we can see that the price to sales was typically 787 for a long time. Then it fell into the 7.3, 6.6 range, 6.3, 6.1, 6.3, 6.5, 6.3. And, the most recent price to sales was 7.1. The point being is that there is a potential reality that what was the normal price to sales for the company will be reset to a lower level if it's true that sales only start growing at about half the rate. Now you can see that for the last year they dropped to 18% growth and then 15% growth and 14%. This is the classic growth stock, no dividend to bail you out. Does have an extremely high price to sales yield, however. Hello everybody, this is Chuck Carlisle, co-founder of FastGraphs, the Fundamentals Analyzer software tool, bringing you part 2 of this week's subscriber request series. In part 1, I covered primarily dividend-paying stocks that you asked about, what I would call, potentially some were dividend growth stocks, some were just dividend-paying stocks. Today, I'm taking the remaining 26 companies that you asked to see last week, and I broke them down into what I would call the total return or growth stocks or non-dividend paying stocks, although there are a few here that do pay a very modest dividend, as you'll see as I go through the presentation. The point being is, though, that when you're dealing with these kinds of stocks, you're going to see a lot of interesting characteristics. One, some of them have very little history. Some of them have almost no history. Some of them are just starting, to grow. Some of them are based solely on growth. Some of them have real cyclical growth. So when you're dealing at stocks, especially when you have no dividend to bail you out, to give you any return of your capital and even on your capital, they're much riskier, in my opinion, than dealing in good high-quality stocks that offer a dividend. But on the other hand, if you pick the right stocks, the right growth stocks, that even whether they pay a dividend or not, they can be some of the best investments. So let's go ahead and go through these 26 companies, starting in alphabetical order. Now, first of all, we have 26 companies here that I've identified. And you can see the companies, right here on this portfolio review. If I put them in order of price-earnings ratios, you see they go from, negative price-earnings multiples where they have no earnings, all the way, to even 1 and 2 times earnings. And if I hit this column again and sort it from highest to lowest, some are even trading at astronomically high PE ratios. We're going to cover whether or not that makes any sense. So let's go in alphabetical order, and let's start with the first one. Now, AutoNation is a very interesting company. What I want you to note here is that if you've been following the used car markets or automobile markets here recently, and this is an automotive retailer, cars have been in unbelievable demand. Car dealers are actually charging a market price penalty above MSRP. In other words, I've never seen that in all my years of buying and selling, my own automobiles over time. I've never seen, the dealers not only not willing to negotiate for prices of their cars, but they're actually adding a penalty over the manufacturer's price. And so you can see that surge in demand, if you will, has translated into unsustainable, and I want to emphasize that, an unsustainable surge in profitability. And now we're coming to the point where analysts are expecting earnings to start slowing down and dropping. But if you look at this stock historically, prior to this aberrant market, part of it may be instituted by COVID. And even if I include one aberrant year with a 53% growth rate, you can see how closely the stock price really tracked the company's earnings. And, that's critically important in dealing with stocks, to recognize that ultimately the business is what generates the rate of return. The stock is the trading vehicle that lets you buy and sell, but what you're really doing, if you're especially a long-term investor, is you're buying the business. AutoNation has averaged about 14% growth, but looking forward, as I mentioned, growth is expected to actually drop, and that's really dropping from an aberrantly high price. This will still be a very high level of earnings for the company. Right now, you can buy the stock at less than a 6 times earnings PE. Of course, no dividend yield, very high earnings yield, but you are going to be facing bad news going forward. So it's up to you to decide whether or not you think, AutoNation really does look as undervalued as the long-term chart makes it look. Again, as you shorten the time frames, you see that the normal multiple on this stock for the last several years has been about 10, and it's currently trading at, almost half that, 5.98 versus 10.12. So there is some upside in this stock, assuming the market continues to even apply a 10 multiple. And at a 15 multiple, you would have really strong upside. So, there's a speculative nature to this particular selection here. And I wanted to make sure when you're looking at stocks and when you're using the Fast Graph research tool, you're analyzing and evaluating what you see and adding some common sense to the analysis to make sure if you think it's sustainable. Obviously, these most recent, 3-year growth rates are not going to be sustainable long term. Aersale Group is an aerospace and defense company. This is the problem I have with the stock. It came out with an incredible, first year of earnings growth, which is kind of really, I'm not even sure how accurate that really is when the way, it depends on how they accounted that. Then we're expecting a down year in 2022 of around 36%. But then we expect to follow that by an 80% growth rate in 2023. Now, I want you to note that we're not really getting much in the way of estimates. We're only getting estimates for this year and next year. And there's only one analyst giving those estimates. So this is the kind of information that becomes readily available if you just look at the tool and work the tool and recognize. So here you're dealing with a very speculative, situation. It does look extremely inexpensive, but you are going to be facing a couple of bad quarters coming up theoretically if this analyst is right. And then you might even see a recovery the following year. But the point is there's speculation in that. So this is one that, you would want to try to learn as much as you could. First place I would start, and Fast Graphs helps you do that, go directly into the company's website and try to understand, what the company does, try to go into investors, services, see if there's any, news and events, presentations from the company that you might be able to look at. And then you can also do things like, with the external links of FastGraph, go to sites like Seeking Alpha and look for any research reports on the company, any news on the company. The key is this stock look worthy or not of conducting a more comprehensive research initiative? And again, I'll let you decide that. I don't like a stock that has such a short history because you really don't know how well the company is going to grow. Is this going to be a persistent trend and then a recovery and then a strong trend going forward? There's a lot of questions, and you'd have to try to figure that out for yourself. The next one I want to look at here is BERY Global Group, and it's a metal and glass containers. Now, I think this is a very interesting company. And again, I want to basically emphasize the value and power of this research tool, Fast Graphs, the fundamentals analyzer software tool that I'm looking at. Everything here is data driven. You've got a 45% growth rate. And so we simply use the P equals growth rate formula as a fair value. That's what the orange line is. But notice how misleading that is because, other than when it first came public, the stock never really smelled that. It traded more at around a 15.5, which is called the normal PE, or you could think of that as the market PE. But I want you to use the tool to its best advantage. Now you see the 45% growth rate was highly influenced by a 940% growth rate we saw the first year, and then we settled into some 20 and 30% growth. So if I simply cut that out, the growth rate now drops to 21%. And again, the PE that seems to make the most sense has been about a 15, but the last 2 or 3 years, it's even been lower than that. So when you're looking at forecasting here and looking at the future growth is expected to still be going at about 15%. The normal multiple has been less than that, 13. And again, you can use the drop down on the normal multiple and even get your most conservative number would be an 11 PE, 11.5 PE, and that still would make this stock look very, very attractive. But once again, it's a growth stock. There's no dividend. The company's trading at around 8 times blended PE ratio earnings. It's only BB plus. It doesn't have an investment grade credit rating. It's a $7.1 billion market cap company, but it does have a lot of debt. So these are things that you would want to look at and talk about more as you go through it. Dutch Brothers is a coffee company that, I talked about Starbucks. I did a full report on Starbucks the other day. You can go find that here on the channel if you'd like. Once again, we have absolutely no history and we do have expectations. So when I look at forecasting, this company is followed by a credible number of analysts. There are 10 analysts giving a forecast for this year and for next year, and then it drops down to 6 analysts going beyond that. I do want you to notice that the estimates were 35 cents for this year 6 months ago, dropped to 29 cents and up to 41 cents, and now they're sitting at 42 cents. So they do seem to be getting more positive, but the high valuation makes this stock look unattractive to me. It does look like, or it is expected to grow very fast, but you have to pay a very high premium to buy it, and we can see the stock price is already starting to drop. So, it was down a little bit, on yesterday's close. I'd be waiting for this one to get a little cheaper. And again, you'd have to spend a lot of time trying to do your own research to figure out whether or not this company does have, traction and the ability to go. Salesforce, symbol CRM, has been also a very powerful growth stock. It's grown at over 50 times earnings. Now we're showing a normal PE of 117, but that goes back because there was a time when the stock did command these 100 PE multiples. Now, if I shorten the time frame, you'll notice that normal PE begins to adjust, and the more I shorten the time frame, the more it adjusts. Use this feature of the tool. So more recently, last 4 or 5 years, this stock has been trading about 55 times earnings. That's a very, very high multiple, I want to point out. It gives you an earnings yield that's, minuscule, if you will. Now you're looking at the stock trading at a blended PE of 35. So if I go into forecasting and growth rate drops down to 14% like it's expected, then, you're looking at a stock that looks very expensive. Now, using the normal PE would, lead you to believe that, the stock would, be a tremendous buy here. But the question I think you need to ask yourself, now that the company's $165 plus billion market cap, is it going to be able to continue to grow and to grow at rates that would support the very high multiples? Again, we have no dividend, and you can see the stock price has already been in a pretty steep decline. Now, sales have been about 28 times earnings. The stock is normally traded at 8 times sales, and sales are still expected to continue growing at about 18% a year. The historical growth rate of sales has been 28. So, this could end up being adjusted as well, but it does give you the ability to see that the stock looks cheap based on its normal historical price to sales. So you want to look at this from as many angles as you can when you're researching these companies. Carlisle Company is a company in building products and very similar to what we saw before with the automobile retailer. We've had this surge in construction and building. Building's been crazy. Interest rates have now begun to increase. Expectations are for building to slow down. The stock followed the surge in growth. We had some tremendous 61% and 81% expected for this year earnings years. And of course, that drove the stock up from $120 some a share to $240 some a share currently. But again, looking forward, we're expecting to see a real big slowdown going forward. And then the question would be, is this long-term growth rate, which is just a trend line growth rate? The only number that's really relevant is this number out here when you're looking at that. I'm going to do a video on how to use the forecasting tool more effectively. Now, this stock does pay a dividend, less than 1%. The white line on this graph represents the dividends. The area below that shows the payout ratio. So you can look at this and see that the payout ratio is around 20-some percent, 23.3 to be precise. And FastGraphs gives you that information visually, but you can also then look at it mathematically. And if you go into the performance report, you will also get dividend growth rates and dividend payout ratios reported as well. So there's a lot of data. The point is it's the fundamentals analyzer software tool. Analyze what you're looking at and analyze the information and make your decisions accordingly. CSW is building products. Again, it's been in a surge. It's really been given a high multiple. Price is starting to come back down to something maybe closer to economic reality. We can see that here. We're simply not getting any estimates for dividends. That's because the analysts aren't making one. The company, if you look at the company long term, it has a very short dividend history. So no one, I guess, is comfortable. No analyst is currently comfortable in perhaps offering an estimate. That's just, speculation on my part. But the point is, it is still expected to grow. This could be an attractive stock or an attractive purchase, especially if the valuation continued to get lower and the stock was down, 2% on yesterday's close. I haven't seen what it's done today. Walt Disney is a very interesting story. We know what happened with COVID. We know, the situation where they had to shut down the park, shut down the cruise lines. The movie business kept them afloat, so to speak, the streaming and the movies. Recently, they've been in the news, a lot of political things being involved with Disney. You can see the stock price has, had a massive correction this calendar year. The company cut their dividend totally. They're expected to reinstate it by analysts, but we really get a distorted picture. Disney might be coming to the point where it's becoming attractive again or getting close to being attractive again. But for the last year or two or three, I've been long saying, and that was before COVID and before the, obviously the thing that was beyond Disney's control happened, that the stock was overvalued. Perhaps it's now coming into fair value. And again, once again, you can see clearly what kind of dividend record they have and how they eliminated the dividend visually on your fast graph. Four-Star Group is another company in real estate development or in real estate. It's purely a growth stock. It's had very spotty historical track record. Last 5 or 6 years or so, the growth has been spectacular. Growth is expected to continue to be in the 19 to 20% range. The normal multiple of the stock has been around 20 times earnings. If you look at it, historically it's even been as high as 25 times earnings and even higher than that long term. So this would be one that, again, is more of a speculation. No dividend, does have only trading at under 5 times earnings. The question is why? And again, it has to do with how sustainable is building going to be once the interest rates rise and, the real estate market maybe goes through a cycle or even a correction. I mentioned Google or Alphabet in my opening comments. It's what we all know who Google is. We can all see the tremendous growth that the company has historically had. When you look at Google from a lot of metrics, earnings don't look as good right now, especially if you shorten the time frame, because earnings growth is still held up at over 20% a year. But it is now beginning to, get to the point where the company is a $1.5 trillion company and future expectations are for growth only to be about half that much. All right. So, if I look at the forecasting graph here, we're looking at around 11% growth. Now it's widely followed. We have a real consensus here, over 45 analysts. If I check the analyst scorecard, they actually have an excellent record of meeting or exceeding or even beating their earnings historically. And what this really tells me more than anything is that Google's an easy company for analysts to analyze, or, because it means the company gives good guidance. There's a lot of clarity. If you look at this company, I'm going to keep the time frame relevant down here. I'm going to do 13 years, so that includes the forecasting years and gives me about a decade of history. You can see it's been trading. It's been only growing at about 17 or 18%. Again, it's forecast to grow at around 11%, so that's significantly slower, but that's earnings. If I look at it from the standpoint of operating cash flow, the stock actually looks very inexpensive. They've been growing their cash flow. Cash flow is expected to continue to grow at we'll call it 15 to 20% per year. The long-term growth expectations about 14%. So the bottom line is this could be a good time to be buying Alphabet or Google as a pure growth stock. And again, no dividend, it's a pure growth stock, but the company also has very minimal debt. It's AA plus rated. So, we all know that story. This could be a great time if you're looking for long-term total returns, because Google has been a great performer compared to the market. It's, close to doubling what the market returns have been. Instead of turning 10,000 into 35,000 like the market, it would have turned it into 70,000 just over the last decade or so. So, Google looks very attractive. Going through other metrics like EBITDA, it again continues to look real inexpensive. And if you look at sales or revenues, the company is still looking real good from a standpoint of valuation. So this would be a growth stock that does look like it's very attractively valued today. The only question in that, or suspect in that, would be earnings, whether their earnings are strong enough to support that. Goodyear Tire and Rubber, I really liked showing this company because this is the kind of company that I personally don't choose to invest in. Now, if you wanted to trade this stock, it might be a very interesting candidate for day traders because of the volatility. But the problem is the unpredictability and inconsistency of the company's earnings just make it very, very difficult to build a position with any confidence. When I'm looking at the forecasting graph, I get really a bizarre picture here because if I look at the analyst scorecard, more than half the time the analysts have been wrong about this company. So it's a very cyclical company, a very cyclical industry. Statistically, it's extremely cheap. They've eliminated their dividend, so it no longer pays a dividend. They have paid one in the past, but the record has been, very poor. So this would be a pure turnaround speculation for those of you that might be interested in Goodyear Tire. This, again, isn't the kind of company that I like to invest in, but I do like the story it tells because it clearly shows how important fundamentals are to long-term stock prices over time. The next stock here is Q Health, which I know absolutely nothing about. I know their earnings are falling. It has no history. There's no forecast on the stock except for negative earnings growth. So even though the stock looks cheap, I'm not sure it would be, it's based on current. I'm not sure what the future PEs would actually look like if you were able to calculate them. This would be one that I would do a hard pass on until I learned more. That doesn't mean forever, but until I learned more. Innova Inc., which is a pharmaceutical company, it's obviously had some very spotty, very cyclical earnings growth. For years and years, the company didn't make any money. The stock price traded erratically over that period of time. They did pay a couple of dividends, but they never sustained those dividends. This is, again, another one that I would just simply pass on. I think it's too speculative. Statistically, it looks cheap, but I think it's too speculative and therefore too risky, at least for my money. Middleby is a really fine company. It's called industrial machinery. It's really food service equipment. They actually have retail and residential, as well as food processing, food service, and beverage. So this is really a fine company, in my opinion. It's a great growth stock. COVID obviously, created the only real dip in the company's earnings. You could see the price fell dramatically as a result of that, the COVID crash, flash crash, I like to call it. But then it recovered very strongly, and earnings growth is still expected to be very strong. But the company's growth is, would technically be fully valued here, but certainly not cheap or not undervalued at these levels. On this, long-term view, it looks undervalued until you shorten the time frame and note that the growth rates have slowed down. Again, if you're a subscriber to FastGraph, use the tool. Don't just look at the picture and take it for face value. Make sure you understand what you're looking at. You can look at the stock, again, from a lot of different metrics. It looks reasonably attractive. This is one that if I really felt comfortable that I had a chance to buy it at really good value, I would. So you might want to take a, much harder look at Middleby, get into looking at research, go to sites like Seeking Alpha, read what other analysts are saying, read the news, check out the company, more deeply. We try to make researching a stock easier and faster for you. That's one of FastGraph's primary goals. Marvell, I think, speaks for itself. The movie industry, if you will, is a very tough industry. I'm sorry, this is actually a data processing company. This is not the company I thought it was. I don't know very much about it. So it's into technology right now. It looks like the technology is really beginning to accelerate. So this is one you could take a look at. It might be an interesting company here. I don't have enough. It is a semiconductor company. I was thinking of Marvel Studios, the company that has all the Marvel superheroes, but I apologize for that. But anyway, bottom line is this company is expected to have a lot of growth. It has been growing very nicely, but in the past it's been pretty cyclical. So again, you'd want to go into the company's website or go into other sites, look for more information on this company and try to determine what they do. But it looks pretty attractive. Again, this was a request, not a company that I personally follow or know. NIO Corp is a classic example of stocks that trade on hype. And now we see that, the company is continuing to lose money and the stock price is now, the hype and hysteria is waning. It's now turning into potentially fear. There's no real fundamentals supporting this stock. Even though the price has come down so much, I would consider this one a hard pass. Navios Maritime is simply, it's a maritime company, obviously, has a really spotty track record. They paid a massive dividend for a while, apparently. They no longer pay a dividend. The earnings are beginning to grow. So again, this could be a short-term speculation, but I'm not sure this is a long-term buy and hold investment that most people would want. If you look at the long-term performance of this company, it's actually turned in negative performance since its inception rather than even generating a number, and that's including paying us some massive dividends back in the day. So again, I don't know that I'd want to waste my time looking at this, but you might. Nvidia is another semiconductor with some very interesting products. The growth seems to be accelerating or staying very high in this company. It's continued to forecast at about 20% growth. Long-term growth on the company expected to be about 24%, 23.3%. This massive correction has now made this intriguing for a growth stock because even though I would consider it overvalued here, if I'm looking at this kind of long-term growth, it could still be a stock that would generate some rates of return. But I'd like to be buying this stock cheaper myself. I think the risk-reward ratio here is a little upside down. I'd want to see more growth and a lower valuation before I was interested. The next stock is Portillos. This is a new restaurant chain. It's again, brand new. It looks like a lot of IPOs. That's why I showed this. IPOs tend to come out with a lot of, enthusiasm and hype and even hysteria, and then they seem to correct, and this may have a long way to go before it gets to the point where it starts making any money. It is expected to start growing in the future. We have one here in Tampa. It's it's got an interesting menu if you're not familiar with the company. It's what they call unrivaled street food. They've got hamburgers, hot dogs, your classic fare. So, Portillos is one that, could end up being a good investment someday. You might want to keep your eye on it long term, but I don't think it makes any sense today. Skyline Champion is in home building. Home building is very hot, expected to slow down. The stock price has reacted to that. The forecasting graph is looking at about 14% going forward, trading at around 13 times earnings. Again, it could be attractive as a growth stock at these levels here, assuming that growth is sustainable, and that's something I would encourage you to really try to figure out for yourselves. Sleep Number is the mattress company, the bed company. It got really highly valued here recently. And, this is one of the stories I like to tell about excessive valuations, which we have a lot of in this market now. We're starting to see a lot of, reverting to the mean, as I like to say, or coming more to reverting to rational numbers. You can see how much this stock has corrected just this year. It's fallen over 70%, and yet earnings expected to fall 15 to 20% and then recover again. So this could be a great overreaction. It could make the stock look very inexpensive here. It does make the stock look very inexpensive here. But again, by looking at this graph, I would be expecting, bad news, more bad news to come up. Again, checking other sites, this is, crowdsourced research here, what the thoughts are of other analysts. Piper Jaffray just apparently downgraded the stock. This is the kind of information you want to look into deeper before you would decide to take a position in Sleep Number, but the stock does look very inexpensive here. Sony Group, I've always had trouble with Sony because you can see if you look at the price-earnings relationship here, it did have some growth here in more recent years. Is expected to drop. Very difficult to forecast this. If you look at their analyst scorecard, it's been horrible over the years. I just don't like companies. I like to see companies that give me some reason to believe they're going to still keep their mojo. And this one's not even expected to have negative growth going forward. Again, I'd watch the statistics on the stock. Does pay a real minuscule dividend, has, almost no paying out 5 or 6% of their earnings in dividends. I just would pass on Sony. Thermo Fisher Scientific is a life sciences tools and services, really quality company. If you can buy it at a reasonable price, I would. I do think the stock continues to be overvalued, even based on a good solid growth being expected going forward. I think, I'd watch this. The price is beginning to correct. If it corrects far enough down here at around 15 or 16 times earnings, I might get more attractive. But at 22 times earnings, 21 and a half times earnings, I'm still not, an investor. Upstart Holdings is a company in consumer finance. They have kind of an interesting niche. I just looked at this because I didn't know anything about them. And, they enable effortless credit based on true risk, they call it. I'd like to learn a little more about it. It could be something maybe that's happening in the future if they really do have, what they're kind of promoting that they have. So this is one you might want to keep your eye on. The stock is certainly cheap enough right now based on what future growth expectations would look like going forward. But keep in mind, this correction has been severe because the growth rate expectations are much lower than what the very short history has shown. We're showing this massive number here. But again, if I shorten the time frame, that immediately drops to about an 18 or 19% number. This tool gives you the ability to make those kind of assessments. Can't overemphasize that enough as I go through these videos. Now, Vontier is another company, electronic equipment. I'm not really totally sure what this company does. They call it mobilizing the future. So, you'd want to go and learn a lot more. But the company's had strung together a couple of good years since they've been a public company. They pay no dividend. Growth going forward is expected to be about 5 or 6%. The stock's real story here is you can buy it at less than 9 times earnings with a very high earnings yield. And they do pay a minuscule dividend right now, but it's really not, they have paid one. I guess it's not really worth talking about. So this is another one that I'm not, because of the newness of the company, I'd be reticent to invest in it here now, but it could be a decent speculation since the valuation does look so low. Zumiez is a clothing company, a retail company, and again, I think these are so fickle. I have trouble investing in them. These are some of the products that they make. You can look at it more yourself. You can see the cyclical nature of their earnings. They've strung together some good years. They're looking like they're going to have about a 5 or 6% growth expectation going forward. There are only 4 analysts covering the company. So again, no long-term growth estimates. This one does look cheap, but again, it'd be whether or not you think that the earnings growth is sustainable and how good it is. Their earnings scorecard is not real bad, but they do occasionally disappoint, so you should need to be aware of that before you make the decisions. But anyway, those are the 25 or 6 growth stocks that you guys asked for. This is Chuck Carlisle telling you thanks for watching. I hope you enjoyed this video. I hope you learned a little bit, if you're subscribers to FastGraphs, on how to use the tool effectively. I think it's very important to remember that it is a tool. I like to call it a tool to think with. If you invest in common stocks, you don't have FastGraphs. To be real candid with you, as biased as I am, I think you're at a disadvantage. So take advantage of our free trial at least and see if it could be right for you. We've got some really exciting features coming up this year for the tool. So for those of you that already are subscribers, if you like the video, give me a like, ring the bell, subscribe to the channel. I appreciate it as always. And I am going to be making some adjustments to this subscriber request series, because as much as I love the fact that you guys have responded to it, that you're asking me to look at all these stocks, and I have got some nice comments even in the last video where I covered over 40 stocks, that, I've got to come up with some way to make this more controllable and to allow you to get a better perspective. But going through a big group of stocks like this, you're only touching the high spots here. Keep that in mind. So I leave that to you to do your own research and fill in the gaps before you invest your hard-earned money, because, stocks can be risky, and especially the kind of stocks I covered today that don't really pay a dividend or offer you any margin of safety without any comfort like that. Some of the dividend growth stocks you can be a little more lenient with, but I do believe there's no substitute for comprehensive research and due diligence. Anyway, thanks for watching. I'll be talking to you guys soon. I am going to cover T. Rowe Price and a more comprehensive research. I'm doing the work on it right now. It's a dividend aristocrat that has become very fair. It looks like it's really fairly valued now, so you might want to watch for that in the future comings. Thanks for watching.